A lot of investors really like the company Netflix, and the reason is that it's shown really strong growth in terms of the number of subscribers, and year after year, the company's revenue continues to increase. However, Netflix has a very serious cash flow problem. So if you look at their statement of cash flows and you take a look at the cash flow from operating activities, you'll see that Netflix actually, in its early years, Netflix was cash flow positive. So it was bringing in more cash from its subscriptions and so forth than it was spending. So remember, cash flow from operating activities is one of the three main line items on the statement of cash flow. You got cash flow from operating activities, cash flow from investing activities, and cash flow from financing. So cash flow from operating activities from the core business of selling subscriptions to Netflix has actually turned negative. Over the past few years, Netflix is actually spending more cash. They are burning cash on their operating activities. So how does a company continue to be financed when it has that? Well, you're going to go to cash flow from financing activities. They're going to borrow or they're going to issue stock. And that's how Netflix has not run out of cash. Even though they've had negative cash flow from operating activities multiple years in a row, they have not run out of cash because they've begun to borrow. And if you look at their debt to equity ratio, you see that in the early years of Netflix, they didn't have any debt. And then over time, they took on some debt. And here's during the Great Recession. Okay, so we got during that time, you could see, oh, well, there was a recession. I could see where they would take on some debt. And then the debt came down. But then it went back up. It went back up over the past few years. Netflix has become more and more leveraged. Okay, so they're just borrowing more and more money. And if we were to take a look at the trend of debt instead of the debt to equity ratio, we take a look at the debt, it was basically zero in their early years. And then now we see, look at it, it's like a roller coaster, that first hump that a roller coaster takes. So they're getting more and more debt that they're having to take on. And you say, well, why is Netflix keep borrowing? Like what is it that is causing them to borrow so much money? So basically, what it is, if you take a look at their cash flow to capex ratio, they can't fund any of their growth. So they're getting more and more subscribers, they're getting more and more, and they're producing more and more content, but they can't fund that growth from the operating cash flow. Because as we saw before, for the past few years, operating cash flow has actually been negative. Okay, so if you don't have any operating cash flow, then you have to fund that growth some other way. And what they're doing is they're borrowing. So they're borrowing money. And you say, well, what do they need the money for? Well, remember that Netflix is primarily streaming. They originally started out as DVD by mail, but around 2011, they shifted their focus to primarily streaming. DVD by mail is not the main focus of the company. Okay, so with streaming, what they have to do is produce content. And they can license that content. That's what they did mainly in their early years. They would license content from movie studios or TV networks. They would pay them to be able to show their content. But then, as you know, probably Netflix has begun to produce its own content. So the production of content, making their own movies, making their own shows, Orange is the New Black and so forth, that costs money. So as they get more and more subscribers and the number of subscribers grow, the subscribers want content, okay? They want new shows. That's why they're coming to Netflix. And so Netflix needs to fund this growth somehow. It needs to pay for the licensing and then the production of content. And it doesn't have positive operating cash flow, so it's having to fund the growth by borrowing. So they're just borrowing more and more money, and they're becoming more and more leveraged. And you see that that's actually why we see that the free cash flow of Netflix, which is just a cash flow from operating activities, but then you subtract capital expenditures. If you look at the free cash flow, it has basically fallen off a cliff. So from 2014 onwards, free cash flow has dropped precipitously. In the main reason that Netflix's free cash flow is negative is because of this cost to license and produce content. If you're curious, the way that Netflix accounts for this, what they do is the cost to license or produce content, they make it an asset. Okay, so that's called capitalization. They make it an asset. Let's say they spend $1 million on a show. They make that an asset, and then they expense it over time. So if they say, okay, well, this show, we're going to show it for 5 years. Okay, so then they would say, okay, $200,000 of expense every year for 5 years. And that's why actually on paper, the company is profitable. So they show a profit, but they're cash flow negative. And so they would take this million and they would spread it over 5 years. So they've capitalized the asset and they expense it over time. And they call this amortization. So these amortized costs Where do they end up on the income statement? Well, you'll see them in an account called cost of revenue. So cost of revenue is basically, don't confuse this with cost of goods sold, because remember, Netflix does not sell a physical product. But cost of revenue, you think of that as the cost of generating revenue. And for Netflix, again, that's licensing and producing content. So licensing and producing content, as they amortize those costs, in the example below, we said $1 million over 5 years, so $200,000. That $200,000 would show up in this account, cost of revenue. Now, cost of revenue is a very significant expense for Netflix, and you see that at one point, it was basically as a percentage of their revenue. If we think about that in terms of scaling it, it was taking up at one point more than 70% of their revenue. In the early years, it was just about a third. So about a third of their revenues, the money they brought in, went to this cost of revenue of licensing content and so forth. But then over time, they started producing more and more of their own content because licensing costs were going up. As demand for licensing or for content went up, more and more, you had Hulu, different people wanting content. So the prices went up, and so they started saying, well, we'll produce our own content, but that's expensive as well. And so we see that over time, cost of revenue became more and more a significant expense. And now we look at about 63% of the revenue. So if Netflix brings in $100 of revenue from subscriptions, $63 of that is going to go toward paying for the when we think about the content, okay, these amortized costs. And so basically they have a very expensive business. There are high fixed costs. Associated with the content. Okay, it's very expensive to be able to have all the different shows that they produce, right? They have a lot of Netflix originals, and then they license a lot of shows. So they have so many different shows that you can watch on Netflix, and there's a very high fixed cost. And you say, well, how can this company ever make any money? How are they ever going to make any money and be cash flow positive? Like, why would investors keep investing and so forth? Well, one nice thing about Netflix is even though they have these high fixed costs, they have very low marginal costs. And when I say marginal costs, I mean if there's one new subscriber right now signs up for Netflix, it costs Netflix almost nothing to serve that new subscriber because they can just watch the same content that everybody else is watching. They've already incurred those fixed costs to get all the content. So no matter how many new subscribers they add, basically the cost of each additional subscriber is not very much. So they have these very high fixed costs of content, but Netflix is basically a company is built to be scaled. And they've grown significantly, but they apparently haven't grown fast enough because their free cash flow is actually getting more negative. Even though they grow and add more and more subscribers, they're not growing fast enough. They're not reaching scale fast enough because their cash flow position is actually getting worse. And so, but ultimately, the way Netflix, if there is a path forward to them being cash flow positive and being a very successful company in the long run, what it is they have to reach such a scale. They have so many users that they're taking advantage of this fact that there's a low marginal cost of serving each additional user. And then even in spite of the fact that they have these high fixed costs of licensing and producing content, that would be the path forward to them actually having positive cash flow in the long run.